So my shining area that I looked at was actually our mobility costs. So our cell phones and iPads and other tablets like that. We were on AT&T, company based in Texas, and most of us in Texas are AT&T. And I had or was able to go just shop around to Verizon, saved the company 14 grand in telecommunications expenses.
Welcome to the Roots of Success, the premier landscapers podcast that brings you the latest tips and strategies for successful landscape business. I'm Jim Calley, one of the principals and coaches of McFarlin Stanford. Jason New and I started McFarlin Stanford to coach landscape businesses after years in the industry ourselves. Now, more than 10 years since we began, McFarlin has a deep bench of coaches and subject matter experts who work with our clients on very specific issues of business. Whether you're struggling with people, profits, or just day-to-day challenges, our coaches and guests have the real-world experience and practical advice to help you build a thriving and profitable landscape business.
Welcome to the Roots of Success podcast. My name is Kevin Keim, and I'm your host today for McFarlin Stanford. I am joined today with Steve Alley and Liz Helton from the McFarlin team. If you guys want to say hello.
Hi.
Hello, everybody.
We're obviously going to start by pointing out the fact, yes, Steve and I are wearing the same polo today, and it was not planned. But either way, we're excited to talk about budgeting today with you all. For those of you who have not met Stephen or Liz, Stephen is our Vice President of Accounting Services here at McFarlin Stanford, and Liz is our Chief Financial Officer, also known as the McFarlin Receipt Ambassador, to keep us in track. Not that I'm ever guilty of not submitting.
Never.
I'm never guilty.
Never, correct. So excited to talk about budgeting today. It's an important part of every business, especially in the landscaping industry where we have a high labor burden, as you all are well aware. So let's start, Liz and Steve, by saying, why should somebody build a budget and take the time to do so?
Well, number one, it's a plan, right? It's important to have a financial plan, goals, set goals for the year. What do you want to happen, right? And just targets for your team. And whether or not you're going to hit 1 million, 2 million, 3 million, etc. What do you have to do in order to obtain that goal? Do you need to hire new people? Do you have to let people go? What is your target labor percentage is going to be? Is it 30% as a whole? Is it 40% for maintenance, etc.? All of those are important as you go throughout the year. You have to be strategic about running your business. So a budget is extremely important before the year starts.
Steve and I have a saying, we like to say that you can only manage the things that you measure. And so I think a budget really helps you measure things going into the future. And as Steve said, it's a plan for what you expect to happen. That doesn't mean that it's never going to change or that there's never a good reason to say below your budget or make adjustments down the road for unexpected things that come up. You can't be expected to have a budget and by November, December, everything's just been perfect. Everything went exactly according to plan. So you have to be a little bit flexible, but it also gives you the ability to look back and say, maybe you're mid-year and say, okay, my crews are asking for more equipment, or we're not hitting our sales goals and the sales team wants more marketing dollars spent. And you can look back to your budget and use that to make informed decisions. Like maybe those are costs that you hadn't anticipated, hadn't budgeted for. And so if you still feel like they're important, you got to figure out how do we do that? Because obviously if you change one thing in the budget, it's going to have a ripple effect and everything else will change as well.
Yeah, well said. There's a quote that I wrote down that I heard a couple of years ago that really stands out. Budgeting is not forecasting what you hope happens. It's assigning your intention to numbers, right? And it's an important thing. So if I'm a landscaper, and I hear this, we hear this quite a bit, right? We're landscapers who never have built a budget. Where do I start?
So I think budgeting always starts with your historical data. Like you said, it's not what you hope is going to happen. So if you look back at your historical data and your direct labor costs always run 35% of your top line sales, there's no point in budgeting 28%. Because given that in your budget, nothing else is going to change, where are you going to find that 7% increased efficiency? You can't just hope that over time, it's going to get better. You have to have a plan for improving it, or your assumption should be that it is exactly the way it's always been in the past.
Yeah, that's a great point.
And if you're new to budgeting, my recommendation would just be, like Liz said, start with historical data and then plug in a growth rate. If you expect to grow 3%, 5%, do that across the board. And then you update the forecast, right? Because the budget is as of 12/31 going forward, right? And a forecast is when you update it every single month. And start there, apply a growth rate, and then update the forecast as you go along. So the following year, you know what you're doing, you become more efficient at it, and it becomes a valuable tool. But especially if you don't have anybody helping you, and you're new to it, because it is complicated, and I would start simple.
So I just want to draw attention back to that comment you made, because I think it's a really impactful one. Describe to us again, or hit the highlights of what is a budget versus forecast, because you just perfectly articulated that.
So a budget is, I would call it a static plan, right? Versus a forecast. Whereas a forecast, it's more dynamic, right? It fluctuates as time progresses.
Yeah.
So you have a budget as of, you created in December, and you don't touch it. A forecast, however, is going to be when you complete a month, when you close a month. So say, for example, if you close January, February, March. So now you have historical data for the current year. However, your budget is not going to change, but your forecast is going to change for those 9 months.
Yeah.
Right? So it's going to be what will happen, where a budget is what you want to happen, if that makes sense.
It does. Yeah. Great. Thank you, Steve, for giving us that guidance. So for those of you who've met me, you would probably think I'm the last person who would be the one who'd host a topic around about budgeting. But just to reference back to my Clifton strengths, my number one is strategic. In this, I probably over budgeted across the board and innovative. I love a good budget. More importantly, I love a scoreboard, and I love being able to communicate. We'll talk all about that today. We'll talk about some of the tools and stuff, to Steve's point, where you just begin and get going. But let's maybe start with what is probably the most common or the easiest thing to start with, which is your top line budget or your revenue budget, and beginning with that. So if I'm a landscaper, Liz, and I wanted to start and build a basic revenue budget for 2026, I know you talked about historical and your historical data as your starting point. What's the next step in taking that to go build a revenue budget for the year?
Well, I think for the landscaping industry in particular, a budget has to be done on a seasonal basis. I don't think that's for most companies generally as simple as a calendar quarter, because the fluctuations really vary depending on the region of the country that you're in. Do you get more or less sunshine? Do you get more or less snow? And I think you have to really plan out. If you have $1 million top line goal, you have to plan out when are the months that you are going to be able to actually produce that much work. January and February for a lot of places might be really slow unless you're pushing snow. And if you get a lot of, that's totally different. But you have to have some sense of the seasonality of your business and when you are going to have the ability to make the sales to hit your top line goal. So you want to spread that, say, $1 million, or if your historical number was $1 million and you say, I want to grow 20% this year, what months is that $1.2 million going to fall in? And I would encourage companies to look back at trends month over month or quarter over quarter, just to see. Steve and I have worked with clients who they may have no reason, for example, for having kind of a bad third quarter, but for whatever reason, historically, they just know. Maybe it's burnout after a busy spring and summer. Maybe their clients are burned out with the spend. Maybe there's other factors at play. But if you know that the third quarter always hurts, you really need to plan for that. That helps you avoid surprises. It helps you understand what you need to have on hand from a cash cushion perspective. Do you need a line of credit? Do you need to tap that line of credit?
You betcha. I mean, for those of you that are in race peer groups, this is why we take a rolling 12 months when we look at our financial number, really to make sure we're taking into accountability the seasonality of the business. And so it only makes sense that when you go to take your budget, that you're accounting for the seasonality in that as well. So it's a good point. So Steve, if I'm using QuickBooks and I'm wanting to do that, what basic tools could I use to be able to help take some of those revenue numbers from historical data and apply a budget for it for 2026 and beyond?
So QuickBooks has a very basic budgeting tool. You're able to create budgets and forecasts inside of QuickBooks Online. Actually, their enterprise suite is much more robust. But for online users, you're able to budget for on your balance sheet, income statement, and then also your cash flows on a different platform in a different section essentially. And so in QuickBooks, you're able to pull all of your historical data for the year, and then you can extrapolate that for 12 months. So basically, if you say, for example, if you made $120,000 in maintenance revenue for the year, it would calculate $10,000 per month, right? So real super simple. And you go down the list in terms of your top line income, expenses, cost of goods sold, etc. But there are a lot of limitations in their budgeting section, right? You can't break it out by class, and that is huge. Something that we stress. It's so important because your maintenance department, your landscape department, irrigation, construction, they're all going to be different. They're all going to have different margins. And so if you're forecasting top line revenue, if one department is going to have a higher margin, your net income is going to be different, right? So there are better tools out there than just using QuickBooks, in my opinion.
Nothing frustrates me more than knowing that classes are set up in QuickBooks, yet we've just completely ignored that one.
Yeah, exactly. It's not even a feature in there. And you're essentially entering data manually if you're not taking prior year data versus in other platforms. And we use a platform called Reach Reporting, and you're able to plug in various assumptions. So if you expect your sales to go up 3%, plug it in. If you expect your accounts payable, what is your average turnaround time for paying a bill? Is it 30 days, 60 days? So that's another metric that you put in there. How often do you collect your receivables? Is it every 30 days? Is it 10 days, 60 days, whatever it is? You're able to plug that in. And you're also able to make calculated fields. So if you expect your direct labor costs to be 35%, you're able to reference that back to your budget on the P&L.
Yeah.
And then we call it a three-way budget tool. And that's something that QuickBooks Online does not have. However, their enterprise version does. And the way that a three-way budget works is that it incorporates any changes that you make in your income statement, and then that changes your balance sheet, and then that changes your cash flow statement. So when you're reviewing this budget, you have a good idea of what your cash flow is going to be at the end of the year. If I make these changes, am I actually making money at the end of the year?
Yeah.
So
for those of you who are listening, you're thinking, oh boy, that's a lot. And it is.
It is a lot. It is a lot. But budgeting it's complicated. It's not easy.
Correct. But it doesn't have to be. Is the thing.
It doesn't have to be. No.
To have people take away, right? For those of you who maybe listen to this podcast and thinking, I've never had a budget. I've been in business for 10 years. I'm a $4 million company. I don't have a budget. That's okay. It's not okay. I want you to change that behavior. But we can crawl before we walk and before we run, right? So I think that's an important part of it. And we'll talk a bit more about tools later in our little show here. But I think one basic thing, I'm sure everyone who knows me is not surprised I'm going to bring up AI. Come on. It's just an easy opportunity in the world we live in.
Great point. Yeah.
Yeah. It happens, right? Take the last 24 months of your revenue, your reports, whether that's from QuickBooks and you're exporting it, whether it's in your operational software, Aspire, Element, Jobber, whatever you're using, go export the last 2 years if you can get it, or 1 year at a bare minimum. At this point, I like to see trends, and so therefore I like to take a bigger picture. take a bigger snapshot of time, go export those revenue by month, import that into ChatGPT, and ask it to break it into seasonality curves and to create a recommendation for 2026 revenue projection, right? So it doesn't have to be as complex as the powerful for budgeting or suite that Steve was talking about. It can be as simple as taking the historical data that you have. I'm also a big believer, and I coach you, and what we talk about in our peer groups, obviously, is you should know your numbers. And so even if it's not an X, and you want to go to our good old-fashioned, tried and true dear friend Excel, do that. Go build a January through December for 2026. Go pull 2024's revenue for January, pull 25's revenue for January, and then start to look at what those are, what your growth has been by percent, and take a basic straight line percent increase to it. That's a budget. It's very rough, but it's a budget. And you're taking into that seasonality that Liz was taking into consideration because you're doing it month by month. And so your historical numbers will help reflect that. So whether you get as complex as Reach or as basic as an Excel spreadsheet, they're all a budget. It's all great.
There's so many tools out there right now. So where ChatGPT, you can plug in your P&L and say, create a budget for me with these assumptions, and it will produce something. And go ahead, Liz.
Well, I think one of the benefits of using, like if you are using QuickBooks for your financial system, being able to upload or input a budget into QuickBooks then allows you to run actual versus budgeted reports, which can be very helpful in terms of isolating maybe where things have gone wrong or maybe where things have gone right. And you can say, okay, because our direct labor is down, now we have extra dollars that we can put towards other uses in the business. The flip side is if somebody goes and blows an estimate and doesn't take into account the fact that materials prices have gone up significantly, you may be in a little bit of a hole. And again, looking at budget to actual allows you to make changes right then and there. You don't have to wait until the end of the year and go, oh my gosh, what happened? Nothing turned out the way we expected it. You can make changes along the way as you go.
Absolutely. And you don't have to just use one platform.
Yeah.
So you can have multiple budgets in different places. So if you wanted to use QuickBooks just for that feature, go for it.
No, make my heart very happy by telling me that I can overanalyze things.
That's my job.
So maybe just to wrap up a point to this, and I think it's really important what Liz just said is whether you're using the budgeting tool inside of QuickBooks or whether you budget in some other possible way, you can still go back and upload your budget into QuickBooks to be able to compare your budgeted versus actuals. So that can be a bit confusing. I just wanted to draw the delineation between the two there because I think it's important to do that. I did that in my past life, right? I would play around with Excel spreadsheets and AI and do whatever, and then come back and put it in books to track where we were as we moved through.
Okay. And a lot of people use the LMN budgeting tool.
Yeah.
Which is a really good one.
Absolutely. Okay. So that's revenue budgeting. And that's one of the basic budgets. Let's talk about our dear friend cost and how we can manage it. And I think that we could spend a lot of time on this. And so just to keep us on track and not have a budgeting podcast that's 7 hours long, although some people may want that, that's not what we're going to do today. We're going to try to keep it a brisk here. I think what we all would want to focus on the one area. What is that one area, Liz and Steve? What do we talk about all the time?
Labor.
Direct labor.
Right? Okay, so this is literally where you win or lose as a landscaper, right? It's that important and impactful to your business. So I'm a landscaper. I've never done a budget before. How do I take labor and how do I budget for it?
So I think it starts with your monthly columns and you have your seasonality built into your top line revenue. From there, if you look at your historical data, and I think it's best to do this on a class by class basis, but you don't have to. If you look at your historical data and you go, we are always between 30 and 32% direct labor costs as a cost of sales, that is the range that you should be budgeting. So obviously your cost of labor is going to go up in the months where you're busier, where you're earning more money. It'll go down in slower months. But as a ratio, as a proportion of your sales, it should be within that range. Ideally, in this industry, we like to see it on average at 30% or below, but we can see wide variation among classes. And that's why, if you can, it's important to be able to get that historical data on a class by class basis. A maintenance division might be running as high as 40% because it is very labor intensive. A design build may be in the 25% or even less, depending on the use of subcontractors. And that's just the nature of the beast. And so it's important that you can break that out by class or by division in your company, because it's the only way really to tell where you're profitable and where maybe you're not as profitable as you think you are if you just amalgamate everything into one company.
I'm going to get on my soapbox for a minute because I want to talk about classes, because I think this is important. And I know we're talking about labor mainly, and we'll stick to that. But costs have a way of hiding if you don't have them broken into classes, right? You could look at your maintenance, or you could look at irrigation, or you could look at anything that looks, and holistically, if it's all just cost in QuickBooks, how do you know, right? How do you know that division of your company is as profitable as it should or could be? And I know that's my soapbox about classes and how you should make sure that you use them if you haven't properly set them up, right? And make sure that you're doing it by revenue and by cost that you have both there. So maybe another way to mention this, and Stephen, and I'll let you talk about this a bit more. I just feel like the way that you can look at this is boil this down to $1, right? So if you know that your goal is to hit 10 to 15% net profit, then reverse it from there and think, okay, what percent of that dollar can I afford to spend on labor, right? And then you can build a formula out from there and back it into your classes. So that's a very simplified way, but Steve, what other ideas do you have for a landscaper who's never built a labor?
First of all, when you're looking at historical monthly, because Liz, I totally agree. It's very important to look at it monthly. But one thing I highly recommend, make those accrual entries, because if you don't, you'll have months to where you make 3 payrolls versus another month you make 4. And so when you're analyzing the seasonality, it's going to be completely different. It's not going to be correct. So when you're building a budget and you're looking at historical data, make sure it's right. Because if your numbers are not correct, what are you doing, right? It's not going to be worth your time creating it. So, yeah. But if you're going to start with, say, like Kevin's example, if you want to start with 10% net income margin, you can work your way up, because historically your overhead expense is not going to change. Obviously, there's going to be periods where they do. Insurance renewal rates are going to change. Your interest costs are going to change. But as a whole, it should stay pretty consistent.
Yeah.
It should stay right around that 30% income range. I would say between 20 and 30 is what I typically see. And so if you know your overhead expense is going to be 30%, okay, well, my GP has to be what? It has to be about at least 40%, right? And so if your labor cost is 30, that doesn't leave you with a lot of room, right? Because then you're going to have to manage materials. Materials costs right now, from what I'm seeing, are so high. And that's an easy way that you can mitigate that low GP number.
Yeah.
Shop around. Look at different vendors. I know you might be loyal to certain vendors, but they might not be the cheapest out there and the highest quality. So that would be because you have 3 main expenses in cost of goods sold: labor, materials, subs.
Yep.
And so it's the easiest way to change GP is going to be managing subs and materials. Labor is really difficult because you're going to have to manage overtime and stay on budget with your ops managers.
Yeah.
Materials and subs,
but it's critical to do it, right? You can't
Yeah.
just focus on the materials alone. Like,
No.
you're not gonna budget, like, squeeze your way to profitability, most likely, right? From a material perspective.
So Kevin, this might be a good time just to talk a little bit about job costing. because if you have a budget and you know what gross profit percentage you need to hit, you can actually evaluate every job on whether or not it's doing that, right? And if it's not hitting the target, was it estimated with poor information? Have situations changed? Or were the original hours budgeted or estimated just completely wrong? And that allows you to evaluate almost in real time or directly after completing a job, what did we do right or wrong? And if there are things that need improvement, like with estimating or with pricing, you can do that literally on the very next job. So you don't continue to make the same error over and over again.
I can't stress enough how important that is on projects that you guys do. A post-mortem, right?
Martin.
Pardon? Doesn't matter. What born, dead, which way you go to look at it. But yeah, just analyze that and see, keep yourself accountable.
And you can do it in QuickBooks. It doesn't have to be in a fancy.
Because every job should have its own mini budget, right? It's priced a certain way. You have a certain number of hours. You have to purchase X amount of materials. So obviously that all has to be priced right in order to produce the gross profit percentage that you need in order to cover your fixed or overhead expenses, which, like Steve alluded to, you pretty much already know. Yeah. They tend to be things that you made decisions about them in the past, and you have to get to the end of the decision period before you can make a big change again to those overhead expense numbers.
Yeah. Now, if you're listening to this and we're talking about budgeting, you're probably your heart's getting heart palpitations and you're worried about this. Let's pull it back to my lovely little KISS method. Keep it simple, stupid, right? So Liz talked about earlier in this section for labor about starting with a ratio, your revenue to labor ratio, right? So I think you can start in a very simple way of knowing, I'm like, okay, I want to be, or we are going to be a $4 million company next year. And I know that our revenue per hour or revenue per man hour, that's an important number to know. You can start to, at a high level, pull in what the total number of hours you would need, and you can work your way from there. But here's the catch that I want everyone to remember, is that when you're looking at hours, what hour are you using? Is it a true labor hour, meaning like it's for payroll? Or are you doing estimated hours at a job level, right? But I want everyone to keep in mind that efficiency matters there, right? Because we're not getting 100% of that labor hour in that job. And so I would always tell everybody, like, I always budgeted 75%. In my mind, let me rephrase that. I expected 75% efficiency of an hour. So I budgeted it out at 1.25 hours. And that's how I could pack in and make sure that you had some wiggle room there on labor. Now, don't overprice yourself on a job, right? Where you have a sales issue there too. So you got to be mindful of this. But this top-down, bottom-up approach to the job level costing is an important way to do it, right? Whether you're using tools like QuickBooks or historical data, you can just use some simple formulas in Excel. Again, I'll try to keep it simple for some people because it's a good and effective way, right? Okay. Biggest thing to remember here is you're not going to save your wage of fruition with material costs. So you got to watch your labor. It's most likely your number one expense. So budget it and manage it tightly, or it's going to manage you, right? As a business. I believe that this is Ian's favorite thing to talk about when he does all of these peer group calls, right? Is your overtime kills you, right? So it's an important part. All right. So let's talk, Liz, a little bit about P&L budgeting. I don't want to spend a lot of time on this because this can get, I know the two of you can really geek out on this.
Sure.
So I don't want to spend too much time on that, but maybe let's start with a high expectation of when we coach our members and other talk at industry events, generally speaking, give us a quick breakdown and percentage of what your P&L should look like. What's your gross profit look like, et cetera?
So if you start with 100%, that's your sales, right? And hopefully nobody's expenses are more than 100%, or you are losing money at the end of the day. If we're on average targeting about a 50% gross profit margin, that means that all of your direct costs, your cost of goods sold, account for about 50% of the cost of the sale. that leaves you with 50%. And if you have overhead or indirect expenses of about 40%, right? 50 minus 40 leaves you with a net income of 10%, which is very solid. If any of the inputs in the 50% bucket or the 40% bucket change, it's all going to flow down to that bottom line for better or for worse. So with everything that we talk about in finances, we always talk about focusing on the things that can have the most immediate and the biggest impact on your business. I wouldn't really spend more than about half a second thinking about what I'm going to budget for my uniforms, right? Because I could cut my uniform budget by 50%, and it's just such a small piece of my P&L that it's not really going to move the needle. It's not worth the effort, right? That's where, as Steve said, you got to look at direct labor, materials, and subs and make sure that whatever those inputs are, whatever those costs are for you, that you are recovering those in your sales price. And if that ends up being so high that you are pricing yourself out of the market, then you really have to think about how much am I paying my crews? Where am I sourcing my materials from? And why are my subs charging me so much? Because you still have to mark them up. There's a degree of management there. And to hit a 50% gross profit margin, really those three big things are what you have to control.
Steve, holistically, what should they expect an increase, just generally speaking, of either materials or even labor, quite frankly, when you're budgeting in the year?
Yeah, I would say on average 3.
Yeah. So the good
Somewhere
3%
between 3 and
increase
5.
across the area is a good way to cover that. I think material costs, we can talk about that. We can focus on that. But one of the, again, you guys know I love me some AI. In the past, when I was an innovative, I took my P&Ls. I did not do a P&L budget. I wasn't that granular. At the end of the day, I still do have a lot of leading with influencing in me. And so I took that P&L and I uploaded that in ChatGPT and asked it to analyze trends in my cost structure. And to Liz's point, there's not a lot of things that are going to stand out, but there are a couple of things that you can find. So my shining area that I looked at was actually our mobility costs. So our cell phones, iPads, and other tablets like that. We were on AT&T, company based in Texas, and most of us in Texas. And I was able to go just shop around to Verizon, saved the company $14,000 in telecommunications expenses, and moved everybody over to a new plan, which is not fun, by the way. But if y'all remember back in time, I did that the week before AT&T imploded. Remember when cell phone towers went down and nobody's phone was working? Oh yeah. I look like a damn genius because we were Verizon. Total luck. More important thing is that I saved $14,000. Is that going to help you every year? No. But there are areas in your G&A that you can look at and find some things here and there. The biggest thing that I always want to point out here, going back to my AI and my love of software, I was actually banned from buying software because, shit adds up, right? Lots of it adds up. Look at that. How many things are on your P&L or in your credit card transactions that are monthly recurring bills for all these little software tools that we can talk about here in a minute, whether it's for budgeting or everything else? It adds up, man. And if you don't pay attention to that or do an analysis of that, it can get a little wild. Again, take your credit card receipts or your credit card statements, upload it into ChatGPT and ask for recurring payments. Let it point to you where those recurring
Kevin, that we see, and it varies widely across the board, in part because insurance is regulated at the state level. And so every state is going to have some different things. But landscapers need a basic level of insurance coverage, right, to protect your assets in your business in the event something goes horribly wrong. And we have always said that you need to shop your insurance once a year. There's not a lot of incentives given for loyalty across insurers. And at the end of the day, it's really a product that you can compare very granularly coverage versus the same coverage. And you would be amazed at the savings that you can find there if you look at it regularly as well.
Yeah. I get
same thing with software, you end up with insurance having like duplicative coverage. And again, that's just wasteful. So to the extent that you can really tighten that up and only pay for truly what you need, you can find some big cost savings there too.
Watch out for Google ads. Look at your advertising expenses.
Advertising, that's another one.
Absolutely.
This is where the whole, you can only manage what you can measure. It is a big deal, right? Because you can throw unlimited marketing dollars at various channels, right? But if you don't have the ability to evaluate, where are my leads coming from? How many of those leads am I actually converting to actual clients or actual sales?
Yeah.
The sky's the limit. You could just keep spending and spending. And maybe the truth of the matter is there's one advertising channel that is your bread and butter. And that's really where you should be focusing if that's the case.
Yeah. I don't want to get into this whole P&L analysis because, again, this could be a whole 7-hour conversation. One of the things that I love to look at, so in our P&L, we broke out our sales costs, so commissions, and then of course our advertising costs. And the number one question I always got from a lot of people that I coach to is, what should that sales and marketing expense be? And the joke I always made was some percentage less than your growth. But because if you're growing, we were growing. We grew on average our 4-year growth average was 20%. And I spent about 19% out of my P&L on sales and marketing. So I spent a lot of money with Google, but we were growing and it worked and we measured it and we knew what we were talking about, Steve. So that's the important part. I cannot stress enough, back, Liz, to your point about the insurance. I can't tell you how many times I hear, I got a friend, I got a buddy, I got a neighbor.
Yeah.
With them for 10 years. Is their loyalty is loyal to you as you are to them? I get it. If they're one of your largest clients, maybe you should consider that. But if they're not, look, there are reports saying that the wild card in the industry is insurance. You can see an 8 to 12% increase in it. And it's such a huge part of your P&L. You should take advantage of it. Do not forget about that ACE Advantage program of ours and be able to help find some potential relief and savings there. It's a big needle that you can move.
And when you're creating a budget, think of percentages, right? Like, so if on average, companies spend between 1% and 3% of top line on advertising. So budget for that. So it's 1% of your top line on your budget is going to go on that advertising line item. 2% of that is going to go to insurance, or possibly even 3%. On average, I see right around that 1 to 2 range. But you at least know there's percentages, so you're able to budget, right?
And what we see with advertising in the industry is if you're spending more than 5% of your revenue on advertising, you should look really long and hard at where those dollars are going, because that is an aggressive advertising campaign and your growth should be reflected in that. If it's not, you're definitely wasting dollars.
Important to note for those of you who don't know my backstory, I worked in the pest control industry. That number doesn't hold true to us. So when I told you my 17, very important. Remember, we're getting to our sales goal, $500 in annual contract value at a time, and you guys are like $40,000, and I'm super jealous and not at all be angry about that. But we're going to move on. Okay, so Liz, we've gone through this exercise. We've budgeted. Now, how important is it to tell your team?
Well, that is perfect segue into kind of the next step, right? Is you have to let everybody know what the expectations are in the areas where they have control. So if on a monthly basis, you have outlined your sales goals and you have a sales team, right? You can break that down into a pipeline, and it's overwhelming, or it could be, right? If you say, hey, you've got to sell $100,000 worth of services in this month. That's a lot on the first of the month, right? To just be hit with. But if you can break down those monthly goals into weekly goals or even daily goals for salespeople, it becomes a much more manageable thing, right? The daily, it depends on the salesperson. That might get a little stressful, but on a weekly basis, right? If somebody's like, okay, if I sell 3 $20,000 jobs a week, that sounds better, right? Than just this big number per month, right? You got to break it down into bite-sized pieces And that allows you to then evaluate at the end of week 1, not at the end of month 1, right? But at the end of week 1, are we on track? Because if you're not, right, okay, what can we do? Because if you're not on track now, you not only have to meet next week's sales goals, but you have to catch up. And so it really allows you to give people manageable bite-sized things that they can control. It's no different if you say, okay, we have a $100,000 job and we have budgeted 32% for direct labor. What does that mean in terms of hours? And then from a scheduling perspective, how many crews, how many people, how many hours? And those project managers, you can hold them accountable to keeping the team on task and obviously getting it as efficient as you can on those jobs.
Yeah, show them what they can control, right?
Correct.
So they can't control your insurance costs. They can't control your interest, your vehicle loan. They can't control your paying 8% on a vehicle, right? Show them everything above the line, everything that's included in gross profit. Just eliminate everything. So if you show your budget to your ops managers, listen, this is our target. This is our goal. Yes. And then as the months progress, that's your forecast, right? For your team, just show them everything in gross profit. They can control that.
So there's so many little nuggets in that. Just to break it down for you, there's a couple of things that were said there. One of them was that, look, if the field doesn't see it, what's the point in budgeting? So that's one thing, right? Just you communicating it. The old tale as old as time is the trickle-down effect, right? Show them your cost of goods and know that nothing, if you don't focus on that, none of the rest of it necessarily matters, so to speak, if we're not profitable above the line. And then the last thing that's in this is that we've talked about this, but open book, right? You're communicating these information to people, right? And letting them know whether you're fully open book. I always talk about the penny exercise or the dollar exercise, where you take your P&L and you break it down, and this is $1 and you have 100 pennies and you explain where those 100 pennies go. Like, you can do that breakdown. It usually resonates a lot better in the field. They can wrap their mind around it a little bit better than showing a giant P&L with every class and every break. That can get a little overwhelming for that. And then lastly, go ahead.
Go ahead, Kevin. No.
I say lastly, I think, so we talk about these things, but then have some kind of a scorecard, whether you're an EOS company or Metronome or any of these operational platforms that are out there for you. Knowing that scorecard, I relate it back to American football, right? You can turn on any game, and we know as Americans, or most Americans, you know who's winning. Well, we know that because there's a scorecard, a scoreboard that tells us who's winning, when the game is going to end, all of these things. Budgets are that. That's when the game ends. It's your clock on the scorecard. It's also where we know our down and distance, and it's how we know whether we're winning, right? But we got to communicate that, but to show that, whether it's on a TV, whether it's on the dry erase board on the wall, whether it's an email or a Teams message or Slack message or a text message or group me, I don't care. Send a carrier pigeon, but just tell people, right? So that they understand, are we winning or are we not?
That's a really good analogy, because when you're looking at a budget, the budget is the first quarter. The forecast is the second quarter, the third quarter, and towards the fourth quarter. That's actually a really good analogy.
God, it pains me to admit this, but I do have to give Chris credit for part of it. Or he's going to come after me on that. So, Chris, you're welcome. All right. Thank you both. I know we could continue on. I want to wrap us up with a few key takeaways that I wrote down as we went through this. So, to quote Liz early on, you manage what you measure, right? So we need to measure things. Historical data is where you start on any of these, right? You don't pull anything out of the air. I did write this in here. I think this is my brain. I don't know if either one of you said this, but also 80% is good, right? We're never going to have this. Do not overanalyze and put yourself into analysis paralysis over this. Please use historical data. Please use trends, but also know that there are so many things. You can't control the world. So you just got to control what you can to try to get a budget that's functional and working well. Upload that budget into QuickBooks so that you can measure your actual versus your budget. Whether you use the QuickBooks budgeting tool or not, there's a difference there. Labor is your number one cost, so make sure to do it. Shop your vendors around so that you can measure your materials outside of your labor. And then communicate your scoreboard and communicate what your team members can control, right? To Steve's point, they can't control your insurance costs. So there's no point in sharing that with them.
And I think it's probably important, Kim, to point out that on the front end, you have to communicate the expectations, right? In order to meet or exceed our budget, we need to do X. And on the backside, you have to go, okay, did we do X? Did we perform better than expected? Or are there areas for improvement so that you don't continue to make the same mistakes or the same misassumptions month after month?
Sure. Great. Well said. Well, Steve and Liz, thank you for budgeting your time. You're welcome. You're welcome. And joining our podcast. For those of you, thank you for listening to this episode of the Roots of Success podcast. We appreciate your time. We at McFarlin are here to help you in whatever needs that you have. If you have any follow-up questions, please feel free to reach out to Liz, Steve, or myself. And we thank you for your time.
All right. Thanks, Kevin.
Thank you.
Thank you for listening to this episode of Roots of Success, brought to you by the subject matter experts at McFarlin Stanford. Have a question you want our coaches to tackle in a future episode? You could submit that at McFarlinStanford.com/podcast. And to find more helpful content from McFarlin Stanford, follow us on X, LinkedIn, Instagram, and Facebook. If this or any of our episodes have piqued your interest in ACE peer groups, we encourage you to join us at ACE Discovery. Just check out the events tab at McFarlinStanford.com. This is Jason New, co-founder and principal at McFarlin Stanford. We'll see you next time.